Ask yourself a simple question. Why is the most conductive metal in the universe, the metal required for AI, solar, and missiles, trading for less than the price of a steak dinner? It defies the laws of supply and demand. Demand is at an all-time high, episode 12. Supply is falling, episode 18. In a free market, the price should be $100 or $200. So why is it $30 or $40? Because the market isn't free. It is managed. The smart money knows that the low price of silver isn't an accident. It is a feature of the system. It is a deliberate strategy to subsidize the American empire and protect the US dollar. But like all price controls, it works until it breaks. And when the dam breaks, the water doesn't trickle. It floods. The first reason for suppression is monetary. Gold and silver are the historical competitors to the US dollar. They are the anti-dollar. When gold and silver go up, it is a vote of no confidence in the Federal Reserve. It signals inflation and instability. If silver went to $100 tomorrow, it would trigger panic. People would dump dollars to buy real assets. So the powers that be have a vested interest in keeping the canary in the coal mine quiet. They use the paper futures market, COMEX, to smash the price whenever it rallies too hard. They sell billions of dollars of paper silver that doesn't exist at 3 a.m. when liquidity is low. This knocks the price down and discourages retail investors. They are painting the tape to make the dollar look strong and metal look weak. The second reason is strategic, the military-industrial subsidy. Silver is a strategic metal. You cannot fight a modern war without it. Every Tomahawk missile contains 500 ounces of silver. Every fighter jet, every satellite, every torpedo relies on silver contacts. If silver was $200 an ounce, the cost of national defense would explode. Furthermore, the green energy transition, solar, depends on cheap silver. By suppressing the price, the financial system effectively subsidizes the military and the tech sector. It keeps input costs low for Raytheon, Apple, and Tesla. Who pays for this subsidy? The mining companies, who sell too cheap, and the retail investors, who hold a stagnant asset. It is a wealth transfer from the producers to the consumers of strategic tech. The third reason is pure greed, bank profits. Bullion banks like JP Morgan historically act as the house in the precious metals casino. They make money by managing the flow. Often they hold massive short positions, episode 17. They borrow silver at low interest rates, sell it, and invest the cash in higher-yielding assets. This is the carry trade. If the price of silver stays flat or drops, they print money. If the price spikes, they lose money. So they have a financial incentive to cap rallies. They use techniques like spoofing, placing massive sell orders to scare the market, then canceling them before they are executed. They aren't suppressing the price because they hate silver. They are doing it because they are short. The fourth reason is geopolitical, resource imperialism. Who produces the silver? Mexico, Peru, China, Russia, Poland, the global southeast. Who consumes the silver? The USA and Europe, the West. If commodity prices rise, wealth transfers from the West, consumers, to the South, producers. Low commodity prices keep developing nations dependent on Western debt. If Mexico could sell its silver for $100 an ounce, it wouldn't need loans from the IMF. Suppressing the price is a way of maintaining the geopolitical hierarchy. It keeps the resource-rich nations poor and the resource-consuming nations rich. You might ask, if they are so powerful, won't they keep it down forever? No, because history shows that price suppression schemes always fail. Look at the London gold pool in the 1960s. 8 central banks conspired to keep gold at $35 an ounce to protect the dollar. They sold thousands of tons of gold into the market to cap the price. It worked for years, until it didn't. In 1968, the market realized the vaults were running empty. The run on gold began, the banks collapsed, the pool dissolved, gold went from $35 to $800 in the next decade. Suppression works like holding a beach ball underwater. You can do it for a while, but it takes energy. Eventually you get tired, and when you let go, the ball doesn't just float to the surface, it rockets into the air. We are at the 1968 moment for silver. The suppression requires physical metal to work. You have to sell real silver to smash the price. But as we saw in episode 16, the vaults are draining. The Shanghai arbitrage is bleeding the West dry. When the physical inventory hits zero, the game ends. You cannot suppress a price with paper if the market demands delivery. The moment the COMEX fails to deliver, the price discovery mechanism shifts from New York paper to Shanghai physical. The suppression dam bursts, and 40 years of stored energy will be released in a few weeks. Let's summarize the investigation. The low price of silver is a gift disguised as a curse. It is a subsidy provided to you by the banking cartel. They are keeping the price low so you can accumulate. The smart money playbook. 1. Don't complain, accumulate. Use the suppression to buy real assets for pennies. You are buying a $100 asset for $30. 2. Ignore the paper volatility. When they smash the price at 3 a.m., do not panic sell. That is a trap. 3. Watch the inventory. The countdown clock is the vault levels. As long as they drop, the explosion draws closer. 4. Be patient. The London gold pool lasted 8 years. The silver suppression has lasted decades. The end is near, but the final battle will be volatile. They are holding the beach ball down. Your job is to be standing there when it pops. This is the smart money wisdoms. The future belongs to the owners.